Sure. Well, can everyone hear me okay?
You're good.
First and foremost, good nodding. I like that. I'll take some of the responsibility for the text-heavy slides, but as Allison suggested, we wanted to convey rich information today, give you something to walk away from. So basically, I just want to share a story about Clean Energy Works Oregon. I borrowed this presentation deck from one that we built back in 2012. I kind of repurposed it for today. So okay, everybody can see the essentially table of contents slide hopefully now. First and foremost, Clean Energy Works Oregon was a municipally led financing program. I thought I'd just walk through a little bit of our key value proposition, quick history, our goals and approach, and then we can get deep into some financing topics, which is where you will find and see the text-heavy slides. First and foremost, one-stop shop was kind of our North Star in terms of value proposition we were trying to create. What I'm not seeing is why. Oh, look at that. It's a double click. I didn't even know that. So here you'll kind of see, I think the main point I'd like to share here is that financing truly is a means to an end. And we discovered that while we embraced the idea of truly being a finance program, so we essentially started in 2008 with a newly elected mayor in Portland. And if you recall, 2008 was the year of the great financial crisis. And so credit markets and financing really was actually a unique barrier of the time. And so the mayor wanted us to address financing. What we discovered is financing kind of on its own without the support of easy applications, robust information, and highly qualified contractors really wasn't that effective. So we were always, as a program, striving for this one-stop shop approach as our value proposition. The next thing I'd like to share is just kind of a quick history of the program so you can kind of have an appreciation for timeline. The strategic plan document that Allison has shared with everybody was drafted in 2010, which you will see here. There's lots of things that happened after 2010. So the plan is great. I think it still holds a lot of value, but there's a lot of rich experience kind of after we developed the plan that I can talk about here or other times in terms of, things don't always go as planned. So you can probably read most of this, so I'll just call it some highlights. Again, 2008 was really the first year. The mayor wanted to do a 500 home pilot, about 10,000 per home. And after President Obama was elected and issued the American Recovery Reinvestment Act, City of Portland's appropriation of funds from that were magically $5 million, which is exactly what we were looking to launch our pilot. We did on-bill financing with the Energy Trust of Oregon and the 3 investor-owned utilities that covered most of Oregon. We had a mission-driven lender, which was very helpful, named Craft 3. Allison has referenced them previously and covered some of their work previously. So they're a nonprofit organization, fairly unique and not very common in Canada. In 2010, you'll see we secured additional money. That was more like on a competitive basis. So if you add up the first $5 million, another $20 million, fast forward to 2014, we got $10 million from the state. There was also some monies directly from the city. So all in, we had about $35 to $40 million over this 7 or 8 year period. I guess for purposes of this conversation and kind of this audience in particular, I think one thing worth noting is that in the 2008-2009 period, we kind of had a loosely held together partnership of organizations delivering the program in its pilot stage. And then in 2010, when we secured the larger funding, the mayor and staff and other counselors decided to set up a new nonprofit organization, which was named Clean Energy Works Oregon, solely for the purpose of delivering this money and supporting this type of program. Some of our goals, just to help you understand how we made decisions. Job creation and economic recovery was number 1 at the time in 2009, and again, maybe number 1 kind of benefit from these types of programs in the current environment, the whatever we want to call it, post-pandemic economic situation. We also had climate action plan goals. We also had market transformation goals and leverage of private capital goals. Those three goals were passed down with our funding agreement from the federal government. They basically said, let's stimulate economic recovery, so jobs, 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 but let's also consider climate change action plan. Let's also consider long-standing market transformation. Let's think about engaging and leveraging private capital. Social equity and access was more of a local, boots on the ground, kind of bottoms up mandated goal from both the mayor and a lot of the advocacy groups. And it was deeply embedded into our organization, into pretty much all the decisions we made. And you'll see some of that reflected even in the financing that we chose. Our overall approach to program design and implementation, first and foremost, was always, and this was something that actually was a fairly big adjustment for me early, was really big tent stakeholder engagement. I mean, we would have bi-weekly meetings with 30 people in them all the time, representing anyone from simply the contractors, lenders, utilities, the city, the state, any nonprofit that felt like essentially they wanted to participate and have a voice. We would welcome them to the table as long as they adhered to respectful professional conduct. From a strategic approach in supporting the program, we made a decision early to start with kind of the best of the best from a contractor's perspective. So we vetted our contractors carefully, and we really wanted the highest quality ones to begin with as the core of our program, but quickly expanded beyond that and tried to be as inclusive as possible, bringing in new contractors and also supporting those new contractors with training, workforce training, certification. Building Performance Institute was a standard that we relied on as a key criteria for contractors. We really invested into IT systems, kind of end to end, to support that one-stop shop, so that it was really easy for a homeowner to apply for the program, monitor where they were in their kind of overall journey, see their proposed bid from a contractor or multiple bids. We also invested heavily in advertising and marketing, which at another time maybe I can share some stories of how that actually created problems for us. We didn't fully anticipate and understand if we were successful in creating lots of interest and demand, that we could actually overwhelm our supply side of the equation, and then therefore jeopardize our brand a little bit in the market from customers having a negative experience of expecting a great service and then not receiving that great service. We used loan loss reserve mechanism to create the financial products that we really wanted to introduce in the marketplace. And I can talk a little bit about that now that we're into the text-heavy deep dive section. You guys can all read, so I'm not going to read this word for word, and I know it's not best practice to have just words on a page in a presentation, but so maybe I'll just cover, again, I've already covered one-stop shop. That was really important to us from a customer value proposition, but it was also important for our primary lender, our on-bill financing lender at the beginning, which is Craft 3. And the words on this page here in regard to it was really their perspective, that if they could rely on a highly trained group of contractors that were going to do good work in the home, that followed a certain protocol that was likely to result in energy savings, they were happy to provide essentially kind of mission-driven capital to a wide range of homeowners and home occupants via the on-bill mechanism. But absent of that kind of quality control, the perceived risk of participating in the program was great enough where even as the nonprofit mission-driven lender, they were going to have a hard time supporting the financial product. Inclusivity was very important, again, across our program, from the financing product to hiring practices at contractors. So we wanted to widen essentially the availability of financial product, the underwriting criteria for the product, and we leaned on, and I'll touch on this a little bit later, but I can mention it now. We really leaned on utility bill payment history as our primary underwriting criteria. And our view on that was that economic hardship can hit anybody, particularly in a macroeconomic crisis like the 2008 one or the current pandemic crisis, and that those, conventional credit score and even current income was really not that indicative of long-term credit risk, right? Because we knew people suffered job losses, we knew people maybe had dings on their credit due to that economic hardship, and we were willing to kind of embrace the idea that those two things weren't as important as did somebody still pay their utility bill. And if they paid their utility bill and we could structure a financial product that largely would result in a very minimal change to their overall bill, because we were going to reduce the energy consumption and then replace that reduction in energy costs with the financing charge, right? The idea that it would essentially pay for itself, which is one of the most attractive things about energy efficiency as compared to other things. Then our theory was that why would people stop paying their utility bill? If they've paid it through economic hardship, they're probably going to pay it forward. And just kind of relied on the behavioral economics of most people are going to pay their groceries and they're going to pay their utility bill first, and then everything else like credit cards and whatever else will come second, and that's okay. So that was our theory and our approach at providing wide access and being as inclusive as possible with our financing offer without being reckless or putting a burden on people that couldn't handle such a debt burden. We wanted to work closely with the utilities, as you can see. Opportunity, I think I've already touched on. Again, like trying to be broad, and that our program activity, again, financing as a means to an end. One of the most important ends was economic opportunity, like real, valuable, durable, in the community jobs to those that might not otherwise have a lot of job prospects. Asset building, which is one of Craft 3's kind of points of emphasis or goals, right? And even building up credit history for people that don't have that. Replicability was important to us, mostly from the federal money, where the federal government says, please, whatever each of you states or cities do, try to think of how it could be replicated in other states, provinces, cities. And then regional, again, the idea that City of Portland took the money or received the money really on behalf of the state of Oregon. But beyond that, it was really important to most of the people around the table that understood, rural communities can often suffer from lack of capabilities and capacity in their smaller communities that are available in the larger urban centers. And we wanted to connect those capabilities and capacities of the urban center with the neighboring rural communities, and therefore encouraging contractors to work outside of the urban centers. Again, we'll do questions at the end, so I'll just keep going through this. It's 1:30, good. So our financing strategy number one was really on-bill loans, and I touched on this already around this idea of the bottom point, utility payment history, as our proxy for creditworthiness. Another comment within that section is that we did have a 10% loan loss reserve that supported our on-bill mechanism, and I don't think we could have achieved what we did without that 10% funded from the federal government. The language in the top paragraph, again, is from the strategic plan, and so really it was our theory that we had to create this quote-unquote predictability of an on-bill loan portfolio that didn't really exist in the marketplace. Now, that said, on-bill financing is nothing new. Like, we did not invent it in Portland in 2008 and 2009. It's been used in the 80s, been used in the 90s, maybe even the 70s, on and off, depending on politics, depending on what was important at the time. So, but that said, there was still largely a lack of familiarity with that type of asset class, if you will. Again, we recognize as a program that we're receiving a one-time, presumably, distribution of federal money and state money, that we wanted to try to build something that would live beyond the initial grant period, which was 3 years. And so our orientation was that if we used our money to originate a portfolio of loans, that we would want to sell those loans later, because that was our recapitalization strategy, so that we could continue our program operations, which would always require some probably grant funding, but that we could create some value and essentially engage private capital into this type of loan portfolio. So what is predictability? Like, how do you do that? Well, really, again, this is one of these financing terms that as we worked at this for a time, what we found, whether it was pension funds, insurance funds, banks, commercial banks, small banks, big banks, credit unions, didn't really matter. commercial banking, commercial lending is really a trailing sector industry, or a trailing indicator sector, where they're going to look at past performance to assess future risk, right? They're not venture capitalists, they're not entrepreneurs in that way. They're highly regulated, typically institutions or sectors that need proven track records. So what we heard was that you guys, us as program administrators, needed to go out and we needed to originate a portfolio of a large enough volume, which we often heard was at least $10 million, if not 20 or greater. And so you kind of have a significant enough sample size to be predictive. And then it needed to be quote unquote seasoned over a 3 to 5 year period. So that was the formula that we were trying to fulfill. So loan volume, we had to drive demand, because if you don't drive demand, you have no interest for energy efficiency upgrades and you have nothing to finance, right? Because financing is a means to an end. And you have to buy yourself time, because you have to show that there's durable performance essentially over a 3 to 5 year period. And then you can have this predictability that essentially institutional investors can buy. So what we were successful in showing was that over a 5 year period, we had very, very minimal losses in the portfolio, which was our theory. So our theory actually proved true in those market conditions. And we were able to sell the product. One other term here, again, I offer is this idea that we wrote in our strategic plan, which was an attractive financial product. And at the time, that meant for us 5% interest rate with a 20-year term was an attractive financial product. That can change with market conditions. In the US at the time, I think 30-year mortgage rates were in the 4 to 5% range. So we were kind of on par, just a little greater than a 30-year mortgage. Now, again, we were also trying to position our financial product as easy and convenient to access. So we would do fairly quick approvals, right? So we weren't putting people through a process that one would have to go through to get a mortgage. So that's often reflected in price of financial products, is ease of access often means maybe a higher price versus cumbersome to access, like a mortgage is the lowest price and obviously the most secure financial product. Our second strategy, as we move beyond or thought beyond the benefits and some of our own limitations in addressing the market with our first strategy, which was the on-bill lending portfolio, was to engage what we called the primary market, which was organizations that already lend money. That's what they're in the business of doing. They're capitalized, they offer consumer loans, mortgages, lines of credit, et cetera, et cetera. So we plan to work with local banks and credit unions. We wanted to create a value proposition to these lenders, so we embedded that into our programming, which is essentially we could drive them new customers and also streamline some process so that when we brought them a potential new customer, it was highly qualified lead, and that reduced some of their own customer acquisition costs, and they appreciated that. Our other thinking was that we could create marketing partnerships with these primary lending institutions such as credit unions and local banks. They have branches with customers that come in. We could put brochures at the teller windows to help advertise our program. They could cross-brand with Clean Energy Works and get that kind of brand recognition and visibility that they were being an active member of their community and supporting job creation through energy efficiency, kind of doing their part, if you will, on fighting climate change and helping with economic recovery. So that was all our theory. This slide here is, well, what actually happened. So what actually happened was we did successfully generate $20 million of on-bill loan products. We successfully sold those, which this hyperlink, I don't know if this gets turned into a PDF and circulated, Avi, but that hyperlink is actually a pass-through to a Craft 3 page that talks about the sale of the loan portfolio into the secondary market buyer, if people are interested in such a thing. We did work with multiple credit unions across the region in Oregon, because we did have some territory in the state that was not serviced by the 3 major investor-owned utilities that we were working with. So there's also municipally owned utilities in the state of Oregon. As many of you know, a province like Ontario has something like 72 local utility companies. So in an environment like that, it actually can be very difficult to do on-bill financing because you now have to coordinate with 72 different billing systems and accounting systems, which is not to be underestimated in its potential complexity. So that's where we work with those credit unions. We offered, and so I would even say this is sequential, these bullets here. So we started with on-bill, we moved into credit unions. We offered the credit unions the 10% loan loss reserve. They were typically very pleased with that. They were very pleased to do the co-branding and marketing of it. And really what they were offering just unsecured loans to homeowners, not on-bill products. And then lastly, I think one of the most interesting experiences we had was approaching a regional bank named Umpqua, which is a multi-state regional bank, and essentially brought them a proposal, which was, hey, you know, we're basically starting to run out of capital for our lending activities. We weren't asking them for program related activities or operating expenses or anything like that. We said, you know, we just need somebody to lend via our existing platform of on-bill utility loans. We brought that to them as a proposal. We put a 10% loan loss reserve on the table. We went through a series of conversations over 3 to 6 months. And finally, they basically came back to us and agreed to offer the loan product that we were seeking, which was 5%. They didn't actually go quite to 20, but they went up to like 15, I think it was, which we found to be good enough. But they didn't want the on-bill platform. And the reason they told us they didn't want it was that they wanted to have a relationship with their customers, and they valued that. And they didn't want to be this anonymous lender behind the utility company's brand. They also told us they didn't want the 10% money, that they didn't need it. It wasn't worth the legal fees and administrative costs. And what gave them comfort to essentially enter the market we had helped create was our strong qualifications of contractors and our oversight mechanisms of those contractors. The chief credit officer just basically said to us in plain English, this market is different than the totally free market of people going out there and hiring contractors on their own, because we don't know who those contractors are. We don't know if those contractors are ripping them off. We don't know if those contractors are actually their brother-in-law and they're colluding to take the money and go on a vacation to Mexico and buy flat screen TVs. Like, we don't know that. But in your program, we know that now. And so therefore we can adjust our rates and terms. So that was one of our kind of, I guess, I don't know, most fun experiences I found it to be of the program, was to learn that, because we weren't even thinking like that. So that's essentially it for today. Hopefully I've left some time for questions. 20 minutes, that seems like a lot of time to have a conversation, but probably will go by fast. Here's a few things that we can talk about next time. Allison said she would like me to maybe do another one of these. She might change her mind after today, I'm not sure. And that's it. Thank you. And if you have any questions, I'm happy to try to address them.